Hello, I'm Charlie Gibson. I'm the head of mining research at Edison Investment Research. And now, as the legendary market commentator Richard Russell once observed, gold always does what it ought to do. It just doesn't do it necessarily when it ought to. And that has left the market in something of conundrum over the last few months, or dare I even say years, as to which way the yellow metal is going. But we're beginning to get indications of the way it could be going, at the very least, over the course of the next few months, maybe up to the point of the next year or so. And as many of you will know, the Fed has been on a pretty aggressive tapering program. During the global financial crisis, it increased the total US monetary base by about 5 times, and it's been steady at roughly those levels ever since about 2012. And last year, or late 2017, the Federal Reserve decided they were going to try and taper, and that is they were going to take $1.5 trillion US out of the US assets. And the question is how will that affect the Fed's liabilities? Because at the end of the day, those two things have to balance. Now, that is taking an awful lot of either currency in circulation or currency that could be in circulation out of the US economy. It's equivalent to 7% of the US economy over 3 years. Now, we're halfway through that process. We're almost exactly halfway through that process at the moment, and you can already feel the sort of tremors that is having in the US economy. You can see it in the sense of what's happening in financial markets and the large drops, the volatility that's been going on. If you superimpose upon that the threat of trade wars as they're being presented at the moment, particularly between the US and China, and things begin to look pretty challenging. This is a very, very hawkish environment. It's not hawkish in the sense that we're used to, in the normal sense of interest rates, but it's having a knock-on effect. And that's one of the reasons, in my opinion, that the Federal Reserve has already rode back on its interest rate expectations over the course of the next year. And if you begin to look at what the market is expecting, it had been expecting continued increases in interest rates. In some sections now, it's actually looking like the market is beginning to price in the possibility of a 25 basis point cut by the Fed over the course of the next year, year and a half, and in some cases, perhaps even as much as a 50 basis point cut. Now, what does that mean for the gold price? Well, there are two things that can happen. We know that interest rate cuts are good for the gold price, especially if inflation is on the way up. On the other hand, there is another possible scenario here, and that is in the event that the Fed doesn't row back, it stops its taper program. Now, I've been looking at some figures recently, and you're very welcome to go and look at my forecasts, but the key point is this. My forecasts, if the Fed were to stop its taper program now, and by which I mean the end of June, whatever my forecasts are, they would increase by approximately 40% if that taper were to finish as early as June this year. Now, it reduces as you go to the end of the year, and as you go to the end of 2020, it makes almost no difference at all. But that, to my mind, is the near-term opportunity in gold. I'm going to leave you with that thought. I will look forward to talking to you about other metals, other opportunities in the near future. But until then, you have a very capital day.